The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive deep into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Nadiah Koh. Despite a backdrop of global uncertainty, rising tariffs, and cautious investor sentiment, the Asia-Pacific real estate market has shown surprising resilience. According to Knight Frank's latest Q2 2025 Capital Market Insights, transaction volumes rose by over 10% year-on-year, with a notable surge in cross-border investments and strong interest in alternative asset classes like data centers and the living sector. But what's fueling this regional momentum? Which markets are standing out? And how are global investors recalibrating their strategies amid geopolitical uncertainty, AI disruption, and shifting demand patterns? To find out more, joining me now is Christine Lee, Head of Research, Asia Pacific at Knight Frank. Hi, Christine. Welcome to the show.
Hi. Thanks for having me.
Christine, we've seen a 10.1% year-on-year increase in APAC real estate transaction volumes in the second quarter of 2025. What's driving this resilience in the face of global uncertainties and ongoing traffic threats?
Yeah, I think this 10% jump is actually quite impressive given, all the global uncertainties and also the tariff threats. So Asia, I think, offers the best of both worlds. For stability, investors can actually look at Japan, Singapore, and Australia. For higher yield or growth potential, they can actually turn to markets like India. So I think in the last quarter or so, interest rates are also helping, while US and European rates kept high, but several central banks in Asia, Australia, China, Japan, and also South Korea, they held the rate steady or they went into cuts. So Japan, for instance, also offers very cheap capital, continues to draw cross-border investments.
Right. Given the rising geopolitical risk and U.S. trade policy ambiguity, how is this shaping investors' sentiment towards Asia-Pacific capital markets?
Certainly, these geopolitical tensions are pushing investors to be more selective, but they are not necessarily less active. So rather than pulling back, I think many are reallocating towards markets that offers a combination of political stability and also economic resilience, such as, Singapore, Australia, which are seen as safe haven markets where, capital can ride out policy swings while still tapping into this Asia-Pacific growth story. So at the same time, I think this thematic plays also remain very strong. So we always talk about the beds and sheds. They are attracting long-term capital, your logistics, your multifamily, senior living, still offering steady cash flow. So many investors are still chasing these opportunities.
Right, Christine. The living sector also saw investment volumes nearly double, driven by major deals in Australia. So what's behind this appetite for residential-related assets?
I think for Australia's residential sector, because we know the growth is very strong over the last couple of years, so this uptick is really, pushing some of the people to rent rather than buy during this period. So rental market is very buoyant. And because of that, the build-to-rent segment, we call it the BTR, becomes very attractive. And that's also encouraged by the recent tax reforms that reduces, the withholding tax from 30% to 15%. So that actually strengthened the investment case for institutional and also offshore capital.
I see. With data centers attracting $2.4 billion in the second quarter of 2025, up over 40% quarter on quarter, how do you see AI and digital infrastructure trends influencing real estate investment strategies?
Yeah, AI and the data center is really the market darling. So really the surge in the data center investment does reflect this growing demand for AI and also cloud services. So we do see investors are increasingly acquiring the entire ecosystem, so including the real estate as well as the operators, to capture both the physical assets as well as the underlying business. So in some markets, I think opportunistic strategies also turn logistics and industrial sites into data center. So for instance, regions like even Johor is gaining traction due to their high yield and cost matrix. And overall, this hyperscaler data center market in APAC is projected to grow from US $100 billion in 2025 to US $300 billion by 2030. So this is expanding at a CAGR of 24%.
So meanwhile, cross-border transactions have reached their highest level since 2022, excluding the fourth quarter of 2024. Are we seeing a shift back to global capital flow normalization? What are the main factors attracting foreign investors?
I think for cross-border volumes, it has always been quite consistent every quarter. I think it only dipped through 2023 and also first half of 2024 because of the high interest rate environment that really kept investors from deploying capital. But I think if you look at the longer term horizon, like a 5-year average, cross-border volume has always been around 11 to 12 billion USD, and Q2 figure really surpassed that. So I think it's an early indication that investor interest has almost returned to the 2022 level.
Right. So Christine, let's take a look at Australia right now. Australia remains a top target for foreign capital. Why is Australia considered a safe haven in the current environment?
I think for Australia, it really benefits from the stabilized yield. So previously, if you look at the pricing, Australia was like peakish, but then it went through a fast repricing cycle. And now with rising rent and stronger underlying demand for all asset classes, I think it's one of the fastest growing market, encouraging, renewed investment. So it's really just a combination of structural fundamentals and also appealing safe haven market status, particularly for very large-scale capital deployment.
I see. Moving on to Japan, Japan has seen foreign investment despite a 14.8% year-on-year drop in transaction volumes. So how do investors weigh short-term volume dips against Japan's long-term stability?
For Japan, I think the attraction is really the positive yield spread. It's still achievable across all property sectors in Japan despite the slowly rising interest rate. So we think that the pace of rate hikes by BOJ is actually quite slow, in fact, slower than anticipated. So the banks are still very accommodative. That is positive for Japan. And also all sectors, especially for rents, particularly in the office market, is actually moving higher. We have also seen vacancy rates in Japan very low now. It's the tightest in Asia Pacific. In fact, it overtook South Korea for the first time since the pandemic. So for logistic facilities, it's also gaining traction. I think there's increased transactions in the greater Osaka area where your vacancy rates are also low.
All right, so moving on closer to home, Singapore saw a sharp rise in foreign capital inflows this quarter. What's behind this surge and how sustainable is it?
I think the growth for the latest quarter was really underpinned by the IOI's group acquisition of the mixed-use development of South Beach. Basically, they effectively, gain the full ownership after the acquisition. And then another big portfolio deal involves Brookfield's asset management's purchase of 3 industrial properties from Mapletree Industrial Trust at about 420 million USD. How sustainable? I think the question here is, the problem with Singapore's market is that the assets are also very tightly held, so they are usually not available. So asset owners usually are not motivated to sell unless there's a premium. Hence, foreign capital can only look at some of the value-add opportunities, basically to increase their return either by refurbishing or repositioning.
So let's take a quick look at the industrial sector. Despite sectoral growth, the industrial sector experienced a quarter-on-quarter and year-on-year decline. Is this just a temporary pullback or a signal of broader shifts in the investor priorities?
Yeah, certainly the Trump's tariff war have some impact on industrial assets. As corporates reevaluate their supply chain strategies, some are holding back on their expansion plans, which have impacted investor sentiment. So on the other hand, we also saw industrial assets are not exactly cheap, given how both rents and prices surged during the pandemic years. And right now, the e-commerce demand is also going through this normalization. Hence, investors are a bit more selective in terms of deployment in case prices correct further due to trade slowdown. But I don't think it's a broader shift in investors' priorities because over the last 2 years, we have seen investors actually shifted away from office assets but going into industrial assets due to concerns over this return to office dynamics and a weaker demand for office expansion.
So the Knight Frank report notes that rising office rents in Tokyo and Sydney are supporting yields. Are we likely to see the revival in interest for office assets, or are investors still cautious?
I think from the market cycle perspective, the office sector in APAC seems to be quite well supported from both the structural as well as the cyclical tailwinds. So as I mentioned, rents have recovered somewhat in the last quarter. In fact, it ended a 3-year decline from our APAC office research. So your tier 1 cities, Japan, South Korea, Singapore, all have very low vacancy rates. Australia also see resilient rental growth trajectory. So that supports the yield and also maintain the positive spread when your cost of capital comes down. So really, this further rate cut could boost Sydney and also, the other Australian markets' appeal to foreign investors.
Right. Christine, what are your expectations for APAC investment activity in the second half of this year, especially with potential rate cuts and a softer US dollar on the horizon?
I think investment activity should recover further in the second half of this year, supported by the potential rate cuts and also a weaker US dollar. I think that's going to improve returns especially for foreign investors. So while this geopolitical and economic risk continues to weigh on investor sentiment, the factors also suggest APAC could see a rebound in deal making and also renewed cross-border interest.
And before we let you go, what risk should investors keep a close eye on as they consider allocating capital to APAC real estate markets?
Yeah, I think investors should also monitor currency fluctuations and also sector-specific oversupply or weak demand in certain markets. And they also need to carefully assess your risk, particularly, paying attention to geopolitical developments. While they can, enjoy the lower interest rate and enter the market at the right time, I think the price to, your return strategy is still the key to success. Yeah.
All right. Some great insights there, Christine. Thank you.
Thank you so much for having me.
Thank you. That was Christine Lee, Head of Research Asia Pacific at Knight Frank. This has been the Wealth Tracker with me, Nadiah Koh.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.